Hi, I'm Richard Murphy, and this is the 27th in the video series on the importance of tax transparency that I am hosting, and which is being made jointly by the University of Sheffield, where I work as Professor of Accounting Practice, the Global Initiative for Fiscal Transparency, and the International Budget Partnership. In this video, we look at tax gap analysis in some detail, my colleague Andrew Baker having introduced the significance of these in the last video. In most definitions, tax gaps are the difference between the tax theoretically owing to a government for a period, if all its tax laws operated as planned, and the total amount of tax actually paid during that same period. They do, therefore, represent the tax losses to tax avoidance, tax evasion, and bad debts, or sums known to be owing but not paid for whatever reason. In my theoretical work on tax gaps, I have extended this definition to include two further tax gaps: the tax base gap and the tax relief gap. The first of these refers to tax bases that a government chooses not to tax as part of its tax strategy. The second is tax not collected because tax reliefs, allowances and exemptions have been granted to taxpayers in pursuit of tax policy for reasons that should be explained by a government in its tax strategy. It is important to note what each of these tax gaps measures and why each is important, working from what might be thought to be the top down. It is also important to note at this point that this whole issue is explored in much more depth in Chapter 11 of the Global Initiative for Fiscal Transparency's publication, Making Tax Work, which was co-authored by Professor Andrew Baker and me. The tax base gap estimates the amount of potential tax foregone by a government as a consequence of it choosing not to tax one or more of the tax bases available to it. It is stressed that this means that the tax base gap does not relate to exemptions granted within a tax base, but that it does instead refer to the total exclusion of a possible tax base from taxation. So, for example, the exemption of one part of income from tax does not create a tax base gap. That cost would instead be included in the tax spend or tax relief gap. The total exclusion of income from the tax base would, however, create a tax base gap. Examples of potential tax bases that are commonly excluded from tax within jurisdictions include income from some types of wealth, many aspects of assets or wealth taxation, land value, and gifts. There are, however, many other taxes that are excluded from the tax base of at least some countries, including on income, sales, and capital gains. Estimates of the tax base gap will only ever be broadly based. They should be estimated to highlight the opportunity cost to a jurisdiction of not taxing these things, promoting debate on what should be taxed. Moving on, I first proposed the idea that a tax relief gap should be prepared because so many people confused the entirely legitimate activity of claiming tax reliefs, allowances, and exemptions with the unethical activity that is properly described as tax avoidance, which is an exercise in trying to manipulate tax law to reduce tax bills payable in a way that no government ever intended. It then became apparent that this tax relief gap had its own important part to play in understanding how a tax system worked. Much of the discussion required on this issue has already taken place in this video series, and most especially in videos 25 on accounting for tax collected and in video 24, where the issues arising from gift tax transparency principle 12 on this issue are discussed in more detail. In essence, this tax relief gap requires that a tax strategy sets out the reasons for each major tax relief, allowance, and exemption. The annual budget for tax collection includes an estimated total cost for each such relief, allowance, or exemption, which is then shown as a deduction from the total tax revenues that might otherwise be collected for the tax to which they apply. The actual cost of these items should be calculated based on tax returns made and other estimation bases for each tax year. This should be reported in the annual tax authority accounts. The total of such theoretical, budgeted and actual costs then comprise the theoretical and actual tax relief gaps for a year. Knowing the tax relief gap lets the following issues be discussed: whether the tax reliefs given are appropriate, whether reforms are required, whether the reliefs are being abused, which might then mean that the variance has become part of the tax avoidance gap, whether additional reliefs are required. In the UK, approximately 1/3 of all potential tax revenues each year are given away as tax reliefs, allowances and exemptions. Having tax relief gap data to inform debate on this massive cost to a government is vital and an essential part of the tax transparency agenda. As already noted in this video, tax avoidance is an activity undertaken by taxpayers who manipulate uncertainties in tax law to reduce their tax bills. We discussed this in more depth in video 21. This tax gap is not to be confused with the tax relief gap. The best way to estimate the tax avoidance gap is to audit the tax returns of the largest taxpayers in the jurisdiction on a regular basis. They might be managed by a specialist unit within the tax authority for precisely this reason. They are by far the most likely to engage in this activity, and so attention should be focused on them. Items to look for include transfer pricing abuse, other profit shifting, recording income as gains, abuse of tax reliefs, allowances and exemptions by testing the boundaries of the law or simple overclaiming, the use of artificial corporate trust and charitable structures to secure tax advantages. I stress, these are examples and they are not a definitive list. Audit results for these tax returns can then be extrapolated to estimate the total likely tax avoidance gap. This estimate is best used to inform anti-avoidance tax policy as discussed in video 21. Revise the tax strategy. Review the allocation of resources to this issue in the tax authority, and more generally with regard to the adequacy of its budget and the training of its personnel. Inform debate on tax penalty regimes that might be applied to those who are undertaking tax avoidance. Again, this list is illustrative and not complete. The next tax gap to consider is the unpaid tax gap. In many ways, this is the easiest tax gap to understand and estimate. Every tax authority will have details of tax declared to be owing to it, which is not then paid. These sums are called bad debts. This figure is the measure of the unpaid tax gap for a period. The figure comes straight from the tax authority's own accounts. The reason for knowing this figure is that doing so then enables a discussion on whether appropriate resources are dedicated to tax collection and to working out how tax collection systems, which we have discussed in this video series, might be improved. This is a vital part of the tax transparency debate. The subject of tax evasion and issues relating to it have been discussed a number of times in this video series, including in videos 11 and 12, and I will not repeat what has been said there on this topic. What the tax evasion gap measures is the amount of tax that is not collected during each accounting year due to the illegal and illicit activities of taxpayers who do not declare and pay the taxes that they legally owe during that period. There is such a tax gap for every tax, because there is no such thing as a tax that cannot be abused in this way. Tax evasion gaps are in many ways the hardest tax gaps to measure. That is because, by definition, they are hidden from tax authorities. That is not true of the tax base gap, for example, which the tax authority or government chooses upon when deciding not to tax in ways available to it, or the tax relief gap, which is also established by government choice, and the tax avoidance gap, which can be estimated on the basis of questionable tax returns submitted, or the unpaid tax gap, which is a figure from the government's own accounting system. There are two ways of estimating the tax evasion gap. Using a top-down method of tax evasion gap estimation, the value of the tax base for which the value of tax evasion is being estimated is identified within the national accounts of the jurisdiction. For example, the likely gross value of wages might be estimated. The likely tax due is then estimated based upon estimates of the likely spread of income, based on known or estimated income distributions, the number of people that are thought to be involved, the estimated value of reliefs that they might claim, and then the actual tax paid, having allowed for bad debt, is then compared with the estimate prepared on the above bases, and the result is the tax evasion gap. Other taxes work in a similar fashion, although different bases of estimation are of course required. For larger taxes, like those on work, profits, sales, imports and exports, and land, this basis of estimation is likely to produce valuable results. The bottom-up basis of estimation of the evasion tax gap extrapolates figures for tax evasion discovered during tax authority audits of tax returns, and assumes a similar rate of evasion across the tax-paying population as a whole. This is the most commonly used approach to estimating tax evasion by those tax authorities that undertake tax gap estimates at present, except for those conducted with regard to VAT across the European Union and in the UK, where in both cases a top-down method is used. The problems with this bottom-up approach are audit sample sizes tend to be small. The approach assumes that those committing tax evasion will be known to the system and so be capable of being audited. This may not, of course, be true. Audits are unlikely to find all frauds. Audit samples may not be representative, meaning extrapolations may be unreliable. Statistically, this method is as a result weak and unlikely to produce very reliable estimates of the tax evasion tax gap. There is a strong likelihood that this tax gap will be underestimated by using this approach. In that case, both methods should ideally be used and compared. Reliable estimates of tax evasion empower discussion on how to tackle this issue, how to improve the tax system, how to deal with the shadow economy, how to better collect tax, how to identify taxpayers, and what the goals of the tax system really are. As this video series has shown, all of these issues matter. In summary, there are 5 tax gaps. All of them are important. All open up debate that is important to tax transparency. Preparing tax gap estimates is almost bound to improve the way in which tax systems are managed. Tax gap data makes the tax system more accountable, and as such, they are at the core of tax transparency, even if they are uncommon outside the EU and G20 countries at present.